Okay. Yeah. Thanks everyone for making time to be with us. Please excuse my very long and messy hair. I haven't had a haircut for 2 months already. Hope to get one soon. So, yeah. Although today the key topic will be about whether we view inflation as a concern or not, we will also spend quite a fair bit of time to talk about what has happened in China. Um, the reason why we want to spend more time talking about China as well, besides inflation, is really because if you look at the past 2 days, yesterday and today, the Chinese equity market has fallen by, I think, 8 to 9% in just 2 days. Later on, we'll share with you what has really happened there and some of the thoughts that we have about the Chinese equity market. So before we talk about inflation or China, we'll kick off very quickly about the coronavirus, the Delta variant. Um, so the big question people have is that is the vaccine working or not? So if you look at the left-hand side, this is UK daily cases. You can see that it has spiked up to a very, very high level. Now, this is because they have reopened, they have the football, Euro Cup, then they have a lot of things reopened. People don't wear masks. So cases are shooting up, and Delta variant is also more contagious. But very good news is if you look on the right-hand side, you can see that the red line, it has come off. This red line is a measure of people are hospitalized for every 100 people who are tested positive for COVID. So if you look at, for example, in February 2021, out of all the positive COVID cases, about 11 to 12% of these people will be hospitalized. But today, only less than 2% of people who tested positive are hospitalized. This shows that the vaccine that UK has taken, which is AstraZeneca primarily, is very effective in preventing hospitalization. The vaccine won't prevent you from catching the virus, but more importantly, the virus can protect you from being hospitalized. And if you're not hospitalized, you won't develop severe symptoms and you're unlikely to die from it. So the vaccine is working. So how about other vaccines? For example, in US, Pfizer and Moderna, and Malaysia, we also use Pfizer. They're still doing studies there. And because Delta hasn't really hit US in a very big way yet, it has started, but not yet, not as severe as UK. But early indication, early studies shows that Pfizer and Moderna are also very effective in preventing hospitalization and death for Delta variant. There's this recent studies that show that out of 100 people that died from Delta variant in US, almost 99% of them are people who are not vaccinated. Among those who died, only 1% of them are the vaccinated ones. So early studies show that Pfizer and Moderna work quite well. Sinovac and Sinopharm vaccine, unfortunately, there's not much official data. There's no concrete data to show how well it works against the Delta variant. Some people say it works, but doesn't work as well. But one important way to look at the situation is really to see what are the governments of the world doing. And because their actions tell you something that maybe the governments are seeing some data, but they are not publishing it yet because it's not official yet. So if you look at Thailand and Indonesia, they use Sinovac, 2 doses for some of their healthcare officers, their frontliners. And now they are thinking about giving them a third shot using Pfizer or Moderna or AstraZeneca. So meaning there is some indication, it's not a concrete proof, but there's some indication that Sinovac and Sinopharm may not work as well. It still works, but probably not as well as what they have hoped against Delta variant. In fact, if you recently I read a news from Nikkei, Japan, a company in China called Fosun. Fosun is also now working with BioNTech to develop a mRNA vaccine, hopefully to be used as a booster shot in China as well. The BioNTech technology, that is the exact same technology that Pfizer is using. is showing some sign that they are probably seeing some early indication that the Chinese vaccines doesn't work as well for Delta variant. So they are also worried. So they are now exploring the BioNTech vaccine as well. So that's about the Delta variant and the vaccine. All in all, we think things will improve, although because of the Delta variant, but things should get better eventually as more people are vaccinated. US and UK will reopen as the number of vaccination increases. In the past 6 to 8 months, China has been slowing down their monetary stimulus. On the left-hand side, you can see is the monetary policy in China. When the line is going down, see, for example, on the right-hand side, this is China's fixed asset investment. You can see that it has also slowed down compared to its history. But very recently, the sign that China is now trying to loosen their monetary policy. Very recently, they made a 50 bips cut in their RRR, reserve rate of requirement for the banks. That's a way for them to increase monetary support. So they are starting to do that. But the second issue, or the bigger issue that is affecting the Chinese market very severely, causing a sharp sell down in the past 2 days, is really the change of regulation, or rather, people will say the change of the government's attitude. You can see that the regulators have cracked down on Chinese internet companies. They have cracked down on education sector. 2 days ago, they said, last week, they said that education, the tuition industry, is not supposed to be profitable. It's not like private businesses can come in, charge a high fee, and then make money out of it. So they want these entities to be non-profit. So clearly, if you invest a stock and from a profitable company becomes a non-profit entity, clearly it's not something that is investable. You don't invest in a non-profit companies. And yesterday, they also came out to say that they want to control the property sector. They have raised mortgage rate to curb the very strong demand. They also tell property developers you cannot high. There will be price control. So all these are increasing, and it does have a negative impact on how foreign investors.
Hello, Mr. Lim. Mr. Lim. I think we lost him over there. Sorry, guys. Yeah, we are trying our best. Mr. Lim, your line is a bit lagging.
Investors, including ourselves, when we buy a stock, we hope that the business can.
Hello, Mr. Lim.
Hi.
Hi.
Can you hear me?
Sorry, we kind of lost you over there just now because the line was a bit lagging. Yeah.
Understand. Can you just give me 1 minute?
Sure.
I will change my connection a bit. Just give me a quick moment. Yeah.
Sure. Okay, for those of you tuning in at home, I'm so sorry. We will have to take some time off. Won't be too long. Okay, so do stay tuned. Do not log off. Okay. We'll allow some time for Mr. Lim to change his connection. Okay.
Hey,
Hey, hi, Faris.
Hi, Mr. Lim.
Okay, can you hear me?
Yep, we can hear you, but your voice is a little bit muffled right now.
Bit muffled. Is this better?
Ah, yes, okay.
Oh, okay. Sorry. Home internet.
Yeah.
I made some changes and I'm dialing in both from internet and also my voice is from the normal 2G line. I hope it'll be more stable.
Yeah. Hopefully it'll be more
Um,
stable. Yeah. Okay. Yep. I'm so sorry. Yep. Okay. You can go on. Yep.
no worry.
Mm.
Sorry, I started to lag at which point when I talk about this slide, is it? Or way
Yep.
before that?
Yep. Yeah. Here.
At roughly here.
Yeah.
Okay. So really to emphasize is that the quick one is that the Chinese government is increasingly interfering and changing the regulation for internet companies, education companies, as well as property companies. So how foreign investors think really is that in the past, the Chinese government, they don't really interfere with private businesses. They tend to regulate the state-owned enterprises, meaning those government-linked companies. But in the past 1.5 years, increasingly, there's sign that the Chinese government is also trying to regulate the private businesses, like internet companies, education, and even property developers. So as a foreign investors, naturally you don't like it. You want businesses to be able to grow their profit. But when all these regulations come in and government trying to control them, people worry about the future profitability. So why is this changing? Of course, there are many reasons. For example, they say, oh, they want to control. They feel that the internet companies are being unfair to smaller companies and customers. They say education companies are charging a high price and it makes it unaffordable for Chinese students to study or have a fair opportunity. Meaning rich people can afford to send their kids to tuition, but people who can't afford it can't send their children for tuition. So they're trying to make all this to be fair. But behind the scene, there's also another motivation, which is more political in nature. Because next year, during the National Party Congress, this is the first time in many decades that a Chinese president will be transitioning from second term to the third term. If you remember, Xi Jinping has removed the term limit to be the China's president. So it's an extremely sensitive time because he is also very worried that there will be people within his party conspiring to disrupt the transition or to object to the transition. So he's doing a lot of things to control everything and eliminate any potential risk. Now you may ask, what does all these private businesses have to do with politics? But in reality, when companies are big and rich, they have money and they tend to attract political friends. So some of them maybe have some connection to people in the political party and they may be supporting some other opposition to the president. So he's really trying to control tightly all the private businesses, installing people from his party inside the companies as well, to make sure that there is no risk of people conspiring to oppose to his transition. So this is a period which is extremely sensitive. In the key takeaways in terms of how we'll invest is the first thing is it's too early to dismiss the risk. Some time ago, people even said that, oh, the regulatory risk has passed its worst. And as it turned out, it continued to get worse until the past 2 days. There is also risk that such behavior to control private businesses it's not only until next year, 2022, it can be a permanent thing. So the big picture is that increasingly we are realizing that China is becoming more authoritarian. The government wants to be more possessive and controlling everything that they can. On our side, we are trying to reduce a bit of our positions in China to manage the risk there. And at the same time, that we do have exposure into other countries. So that diversification has helped to cushion the pain in the past 2 days as well. So that's China. And moving on is that's China internally. The issue between China and US, that's also another issue. That is something that for a long time we've shared that it's something that we have to live with for many years to come. But there is recent development. Recently, US government has came out to say, to tell US businesses that are operating in Hong Kong, to be careful because things may change and you may suffer some of the risks when you operate your business in Hong Kong and China. But it's just a warning. They are not stopping the US businesses or asking them to repatriate, but they're just telling them what to look out for. But the thing is, when you issue such warnings, it plants in businessmen's brain that, oh, they have to think, it will make them more careful and more cautious about increasing their foreign direct investment in Hong Kong and China. So over the long term, what the US government wants to do is to gradually steer US businesses away from China and Hong Kong to shift to other countries, whether it's ASEAN or Europe or Latin America or Mexico. Another thing is, very recently they introduced a new bill basically to ban Xinjiang products due to forced labor issue. They're saying that all products will be banned unless you can prove that the product does not involve forced labor. So imagine if you're importing products from Xinjiang, now you have an extra hassle, extra work to do. You have to have evidence to prove that they are not involved in forced labor. So from some businessmen, they'll say like, with all this hassle and difficulties, I might as well try to import the products from other areas instead of from Xinjiang. Again, the intention is really to steer businesses away from being too reliant on Chinese products over the long term. These are just small ways to steer their behavior. Besides that, China itself is also discouraging its Chinese companies from listing in the US. They've launched all this cybersecurity review as a reason to stop companies from listing there. The recent one is the IPO of TT in US. TT is like the Uber of China. 2 days after the IPO, the Chinese government came out to ban TT's app from being installed in the Chinese app stores. So China is very stern and is very serious about discouraging Chinese companies from listing in the US. This thing will continue for many years to come. How will that affect China? It doesn't mean that China will go into recession, no more GDP growth. It just means that, let's say, before all this war issue, let's say you imagine China can grow its GDP by 6% every year, for example. But going forward, because of all this issue, this slow and steady increases in conflict, growth can slow down to 5% and 4%. Meaning it does affect China's ability to grow as fast as it wants, but it doesn't mean that it will push China into negative growth or zero growth. So China will still grow, but probably not as fast as what people expected before the trade war and all this US-China conflict. Now to go beyond China, to look at the bigger picture, the world, including US, Japan, Europe, and to a certain degree China as well, have cut interest rates aggressively and embarked on quantitative easing to save the economy and the financial crisis last year because of COVID-19. But now, if you look at places like US and Europe, the economic recovery has been very sharp and quite healthy. And because of that, people are now worried about interest rate hike and tapering, as well as quantitative tightening. So sometimes people worry that, when central banks raise interest rates, when there's a rate hike, does it mean that recession is coming and the stock market will start to collapse? We just want to explain that that's not really how it works. Interest rate can be increased for some time, maybe 1, 2 years, or even 3 years or longer, before interest rates become too high and start to cause economic slowdown or a recession and triggering a bear market. So this chart shows you the red bars show you US interest rate. You can see from 2016 until 2019, the Fed in US increased interest rates by roughly 5 times. So the rate bars has increased. But if you look at the blue line, that is US stock market, it continues to go up. Because in the early days, when interest rates is so low and you start increasing interest rate, it's still at a very, very low level. It will not affect people's spending behavior and it won't slow down the economy that much. It's only when interest rates get to a very high level that economy starts to slow down and the risk of recession is higher and the risk of bear market is higher. So what's to watch out for really? So the question is, how do we determine when it's too high? When is interest rates too high? The two key indicators to watch out is first employment, because if employment fully recover to pre-pandemic level, meaning many people have a job, and when many people have a job, steady income, stable income, they are more comfortable to spend and to buy a new car, to change houses. That's when inflation tends to pick up. But if you look at today, even in US, one of the country with the fastest economic recovery, employment is still 4% below pre-pandemic level. And people are saying that for this 4% to recover back to pre-pandemic level, it can take 1 to 2 years. Why 1 to 2 years? Why so long? The reason is because there are a lot of small businesses that have gone bankrupt. And just because everybody is vaccinated doesn't mean that this businessman that has gone bankrupt can just suddenly come back with new source of new capital to build back the small businesses. They will need time to repair their balance sheet before other entrepreneurs come into the market. So the final leg of recovery for employment will usually take quite some time. So our thoughts about when will interest rates be too high and triggering a recession, we are thinking that it's very unlikely to be in 2021 or 2022 because we don't think employment will recover that fast. US is the fastest in recovery, probably will take another 1-2 years. But how about Europe? How about Japan? How about ASEAN? We are much slower in vaccination and much slower in our economic recovery. Malaysia, we can't even talk about economic recovery yet. We are still struggling with the virus. So for the rest of the world, it can take even longer. It can be 3 years. So recession is more likely to happen after 2 years from today or 3 years from today. That's our train of thoughts about interest rates, inflation, and recession. Now, but to share a little bit more about inflation is the numbers look very high and people are worried about it. At the top, if you look at these bars, you combine all the colors, that is the inflation data on a month-on-month basis. You can see that in the past 3 months, April, May, and June, the number is very high. But if you look at the darker green line, the lighter green, that remains pretty stable. So what is it about the darker green and the lighter gray that has pushed up inflation so much? These are things like airfares and hotels. Last year, what happened is a lot of airline company and hotels, they cut capacity, they lay off people. And now that Americans are, many of them are vaccinated and suddenly wants to travel, the Americans are starting to spend and demand for hotels and flight tickets spike up. But the thing is, hotels and airlines company, they have fired a lot of people and they haven't fully hired back everybody. So there's limited hotel capacity and limited flight capacity, but demand is so strong. That's why they can now push up the price very, very high. And the second thing that's pushing up the inflation is the price of vehicles and price of vehicle rentals. What happened last year was a lot of car makers, they suffered deep losses because of the virus. And now suddenly demand is recovering. They too have already laid off a lot of people. They have reduced their inventory. So suddenly there's a shortage in cars. But the good news is this shortage in cars is a temporary thing. They are hiring back people, increasing production capacity, and they are also securing more semiconductor. So the inflation from cars will eventually subside. Inflation from airfares and hotel will also subside eventually as they hire more people and there's more capacity. So, which is why in the near term, we are not too worried about inflation. We think the high inflation is likely to be temporary. But what's more important to watch out for is 2 years from today when employment fully recovers and people have their job back and they spend more money. Usually that's when inflation tends to be a concern, but we are not there yet. Some people, they are now trying to argue about what will happen 2 years from today. Some people say inflation will be very, very high because of all the QE and fiscal stimulus. Some people say that not really, it will probably be still okay. There are really two arguments there. Both arguments are fair, they have their own reasons. In our view, it's quite hard to be very sure about what will happen 2 years from today because inflation is also determined by how aggressive is the fiscal stimulus, how loose or how tight the central bank's policies are. If central banks don't raise interest rates quickly, then inflation will be higher. But if central banks know that, oh, inflation risk is there, so I have to raise interest rates quickly, then inflation won't be that high. It also depends on how fast technological innovation is. If technology improves very fast, it tends to be deflationary. Because when technology improves, it's typically cheaper for us to enjoy the same thing. But having said that, although we are not very worried about inflation in the next 1 year at least, one thing that we are watching out is really valuation, especially in the US equity market. In Asia, valuation is okay. In fact, valuation has come down so much after the recent sell down in China. You can see valuation is now at about, this is PE valuation in US, it's about 21 times. If long-term average, it's roughly 16 times. So it's a bit expensive there. But one of the reasons why it's expensive is really because of bond yield. Bond yield has come down so much in the past 10 to 20 years. So to a certain degree, it somewhat justifies a higher valuation for equity market. Think about this. If you invest in bond and the yield is so low, you have no choice but to invest more into equity where they are paying a higher dividend yield as well as their earnings yield is higher. So that's how the pension funds, the large asset allocators are thinking. So what happens to the bond market? It will also affect the equity market. So to a certain degree, while this chart compares to the history, it's not a very fair comparison because bond yield has also come down a lot. This section is really to share our view about what will happen in the second half of this year. Besides whatever we have shared, is that we think second half of this year, economic growth will still be healthy, but it will be much slower than what has happened in the first half of this year. The reason is because first half of this year, we have a lot of fiscal stimulus. For example, in US, almost everyone received 1,400 checks, whether you have a job or you lost a job. So that's a huge fiscal stimulus. But going into third quarter and fourth quarter, when you compare against the first half of this year, fiscal stimulus will be much slower. So with that in mind, the things that we are doing for our fund and our fund strategy, the first is that we expect second half of this year to be much more volatile because growth will slow down globally. Some of the things that we are doing to our fund is we have recently trimmed our Chinese internet exposure. In fact, we've been trimming Chinese internet exposure for the past 6 months. Our mistake is we didn't cut it fast enough. The truth is we didn't expect things to deteriorate so much in the past 2 days. So we are caught off guard somewhat, but the good news is we are diversified into other countries as well, so that helps to cushion the fund's performance. We have also trimmed financial sector because the banks tend to do well when economic growth is strong, bond yield is rising. But now because people are thinking second half economic growth will still be healthy, but slower, so bond yield has also declined. So banks has also underperformed. So we've trimmed this quite ahead in time. We trimmed this about 2 months ago. We've trimmed semiconductor because they have done so well. We are taking some profit off the table. Recently, what we did was we added companies that are exposed to electric vehicles battery production. These are some of the lithium companies. We've also added into consumer staples and healthcare. Because these two sectors tend to be more defensive, they tend to do well when growth is slowing down, which is what we expect in the second half of this year. But that's the modest changes to the portfolio. The core of our portfolio, which we didn't change much, is that we're still holding on to a lot of these long-term growth names. For example, Amazon, Taiwan Semiconductor, Samsung, and Nvidia. We still like these stocks for their longer-term prospect. Although some people say, hey, if inflation is higher and bond yield goes higher, typically the growth stocks don't do too well. That's true, but as shared earlier, our view is that it's too early to say whether inflation will be a problem 2 years from today. And secondly, we think, yes, inflation and bond yield matters in determining which sector does well in the short term. But in the longer term, it is not bond yield that drives stock prices. It's the company's ability to grow its profit. It's the fundamental that drives long-term share price performance. And a lot of these long-term growth stocks that we like, they do have a very strong potential to grow their profit over the long term. So we are still quite comfortable with these names. We have also recently added more positions into commodity companies like copper, for example, and aluminum. The reason is also related to electric vehicle and all this green energy. Just to share with you, to produce an electric vehicle, it consumes 4 times more copper compared to a normal traditional car. Meaning, as more people convert into electric vehicle, the demand for copper will be much higher than before. And to support green energy, a lot of countries need to build a smarter grid system. And when you build a grid line to transmit electricity, you tend to use either aluminum or copper as well, which is why demand for these materials will be very strong in the next few years. Just a quick one about the top 10 stocks owned by one of our funds, Affin Hwang Select Asia Pac ex Japan Dividend. As shared, we have names like Amazon, Taiwan Semi. We still have Alibaba and Tencent, but we have cut our position quite significantly over the past 6 months. Other names that we like are Nvidia, and other names that we like is HDFC Bank and Indian Bank. HDFC Bank is very well run. It's almost like Public Bank of Malaysia, except that it is still growing very strongly. Bank penetration in India is very low. So it's a bit like buying a very good bank like Public Bank, but 20 years ago when Malaysia is still growing very fast. So that's how I think about HDFC Bank. On this fund, just to share the track record, the average annual return, including dividend for this fund, for the past 3 years was 12%, past 5 years was 13%. Dividend yield for last year was about 4-ish%. I won't say it's the best funds in Malaysia or the best funds anywhere, but I would say that it's among the better funds. If you look at the past 3 years, we've won a few awards. This year, we won the Morningstar Best Asia Pac Equity Fund Award. Last year, we won the Lipper Award for 3 years and 5 year category. 2019, we won Morningstar Award as well as a Lipper Award. So that's really briefly about the fund. And with that, I will open to questions.
Okay, thank you so much, Mr. Lim, for your sharing. Okay, we have a few questions here in regards to the Chinese stocks. I believe that yesterday and also last week, it has taken quite a beating. So maybe you would like to address some key issues here lah, yeah, uh, that our attendees has been bringing up. So the first question would be, okay, now that the price have already corrected so much from the peak, okay, if we look at one of the Chinese internet technology funds, KWEB, it has been down 50% up to today. So yeah, this is just one of it lah. Okay, what is your outlook on it? For those who haven't participated, is this a good time for them to participate in this sector? Or those who have been currently holders of this particular sector, what are they supposed to do at this point of time?
It's a bit tricky. I'll be very honest with you. The problem that the Chinese internet facing now is really it's primarily about what the government is doing, what the regulators are doing. And to a large degree, China being China, when the regulators and when the government does something, they don't explain it very well to you. And to a certain degree, they are quite secretive about their real objectives. So the problem with that is we do not know how long that will last and what is the actual impact on businesses. So I'll give you an example. Earlier on, when the whole thing started, when we look at Alibaba, we thought, hey, share price has come down so much, more than 30%. And when we look at valuation, it looks very, very attractive for a company like Alibaba. It looks very cheap and it's a screaming buy. But as we spend more time to understand what's happening, understanding the intention and motivation of the government, I must say that we have become more careful about it. Although share price has come down a lot and valuation looks cheap, but there is still risk there. And the risk can be such that what appears to be cheap today may not necessarily be that cheap. I'll just give you an example. Recently, after all the issue that Alibaba faced, during the quarterly results, Alibaba came out to say that we will reinvest all our incremental profit back into the business. What this tells you is that their profit is growing very healthily, which makes the valuation look cheap. But they have decided to reinvest all this additional profit. How they reinvest, they don't share. It can go back into subsidies for merchants, subsidies for consumers. So meaning their profit, which is supposedly able to grow, but now it's not growing, it's flattish. Now, when you bake in a flattish earnings growth instead of a 20% earnings growth that Alibaba can do, suddenly the valuation doesn't look as cheap as what we thought it is. Or in other words, now we are a bit worried about the future earnings. Expectation have to be cut down. So when that is cut down, then your valuation may not look that cheap. But I must caveat is that although the risk sounds very negative, but I must say that the reality is nobody knows. We also don't know how long this will last. Or maybe 2 years or 3 years from today, the government will say, okay, everything goes back to normal. You guys can grow the business normally. But if you ask me, for someone who doesn't own it, I would say it's okay to buy some, but don't be too aggressive into it. The risk is really still there. And the Chinese government, you cannot think of it as a normal capitalistic company. Profit keep growing. Because they are thinking in terms of socialist now. They're probably thinking, hey, these internet guys are making so much money. What's the big deal if they earn less? and let other people earn more, let the smaller merchants or consumers get back more. So that's the socialist mindset. And when you invest, you have to keep that in mind. The longer term outlook may not be what you imagine compared to other normal stock investments.
Or in other words, compared to the performance that you did last year. Yeah.
Or maybe in the past. For example, in the past, Tencent can just grow. Nobody will disturb them. Nobody will say, hey, you're making so much money. It's like, oh, you're making money? Oh, good. So things have changed.
Okay.
Yeah.
Is it safe to say that this risk that you have particularly pointed out, is this a temporary risk, or is this a permanent risk, or maybe it's just a temporary risk where investors have to be mindful moving forward? What are your thoughts?
A year ago, I won't even have thought of this risk. Today, if you observe what the government has done, you will feel that this risk is getting higher and higher. Risk of permanent control, or you can say risk of permanent change in government's attitude. I would say the honest answer is I will take this risk very seriously. The truth is I don't know whether it's temporary or permanent. If it's temporary, all is good. We just sit tight or we buy on dips. The question is really, is this permanent? The answer is I don't know, but increasingly, I am worried that it will be permanent. If you look at other countries, for example, Russia, where it's very authoritarian, there is election, but you know it's fake election, right? Putin is the most powerful guy who controls everything. I'm not saying China is like Russia, it's not, but there are increasing changes there. For example, it used to be 2-term presidency, now it's unlimited term forever. And if you look at the long Chinese history, for example, during back then in the days when there are kings, monarchy system, when you have a good king, then all is good. But if you have a bad king or an insecure king, or a paranoid king, then things can get very ugly. So if you ask me, for someone who is investing long-term for their retirement, I think they have to start to keep this in mind already. China today compared to China a year ago or 2 years ago or earlier, I think the landscape has changed, and we have to be more careful about it. So if, let's say, last time I will park 30% of my personal savings in China asset, but going forward, maybe instead of 30%, I'll park 15% or 20%. I think it's a fair way to look at it because the risk is getting higher. Of course, I cannot tell you whether the worst case scenario, like what I said, will happen or it won't happen. The reality is I don't know because it's really hard to predict what the government will do.
Okay, thank you so much, Mr. Lim, for your honest opinion. Yeah, I think a lot of our viewers would appreciate your answer. Yeah. Okay. So let's bring it back home to Affin Hwang. So now that we know that the risk is there for these tech stocks, especially in China, are there any small cap stocks or rather small time stocks in the China landscape that Affin Hwang is looking at right now?
We do. In fact, we have a small cap fund as well, which looks at small cap stocks everywhere, including China. A number of them were also hit because some of them are internet and software related. The area that is doing very well is those related to semiconductor, physical semiconductor, not software and internet. The reason is because US is restricting export of technology, particularly relates to equipment and semiconductor, to China. So China has to speed up and build it themselves or improve the knowledge and the skills in this segment. Because semiconductor is very important, whether it's for your day-to-day cars, appliance, computers, it's also very, very important for your military, your planes, your ships, your missile, your satellite. So it's very important for national security as well. So the semiconductor space has done very well, including the smaller caps ones. But is that a recommendation to go jump in now? I'm hesitant because some of them have done so well and so expensive. Not saying all of them are things that you shouldn't touch. You may find here and there some potential, but you just have to watch out that some of them have done really, really well and a bit irrational. Especially today when they are avoiding internet and software, then they are also avoiding the real estate property developers, avoiding the education. There's so little things to invest in China now, especially in the past 1 week. So some of the money is flowing and pushing into some of these sectors that are protected into a very sky high level. So it's also dangerous in a way to jump in. So tricky situation.
Perhaps out of China, are there any other regions or other sectors that Affin is looking at right now?
Okay, I understand. Out of China, because a lot of our Asian funds by Affin Hwang, we can invest up to 30% outside Asia. We have maxed out almost 30% into US. So in US, we own names like Amazon, Nvidia. We also own names like American Eagle. Some of these I won't say we buy it because of the sector, we like the sector, but we buy it more of the angle. For example, in the case of Nvidia, the company is producing chips that are used for artificial intelligence processing and machine learning processing. And I think the world is in very, very early stage. So Nvidia will be one of the main beneficiaries because demand for their semiconductor chips will be very strong. Because all the big companies in the world, now they want to build their AI capability, their machine learning capability. So they will need the chips. Amazon is not just the largest e-commerce company in US. Now, you may think that e-commerce is such an old story after so many years, but the truth is e-commerce penetration in US is only less than 20% today. So 10 years from now, it can be 40% of penetration. So there's still room to go. And almost half of Amazon's profit comes from cloud computing. So while everyone thought Amazon is e-commerce, actually half of the business is cloud computing.
Yep.
American Eagle is a brand. They managed to win a lot of market share from Victoria's Secret. So it's rising popularity in US. So we have a lot of US names. We have Microsoft. Yeah, we have a few of them.
Yeah, okay. Yeah, thank you very much. That's again another good answer. So I believe some of our readers here, yeah, your questions have been answered. Mr. Lim has gave quite a concise answer. So okay, let's talk about maybe we take this as a last question, okay, for the day. Let's talk about the rising inflations and the fact that because you have also said that for until end of this year and also probably next year, we will probably not see a recession coming, right? But what if it comes? How bad would it look? Will it be as bad as the 08 or will it be like a rebound? Or what do you think will be the events to trigger and a happening like this? Yeah.
By right, I should answer the second part first. What is the events?
Sure. Sorry about that. Yeah.
No, but I'll answer the first part first.
Okay, sure.
It won't be as bad as 2008. I'm quite sure about that. The reason is because 2008, it was not just an economic recession. It was a financial crisis because many people in US and Europe, they buy property aggressively. Like normal people who can't really afford it are like buying 3 or 4 properties to punt on it. They borrow money more than what they afford to pay. And then these mortgages is repackaged and sold to many banks in the world. And when the whole thing blew up, all these banks also collapsed together. So that was a crisis. Today, when you look at the banks, because of regulation and also because of the painful lesson that they have gone through in 2008, although it was 2008, the banks did not fully recover for the next 5 to 8 years after 2008. So it's a very recent memory for them. Because of the painful lesson, as well as US regulation, they have actually cleaned up their book significantly. Today, the US banks, when you look at the book, how much they invest in other assets like bond or property, it has come down so much. Not just US, even European banks as well. So I would say that the risk of financial crisis is actually very, very limited. In fact, last year was a very good example. If there is some kind of financial risk, it would have blown up last year. But last year, you didn't see anything blow up. You don't see banking sector blow up. You don't see any big sectors blow up. You only see everyone panicking and sell financial assets, and suddenly everybody wants to hold US dollar, but they cannot get enough US dollar because they view US dollar as the safe haven when things collapse so quickly. So last year was just panic selling and a very deep recession within a very short period of time. There's no financial crisis blow up, nothing blew up. But if you consider how sharp the sell down last year during March and how deep the recession, although it was very short, but it was very, very deep. The fact that nothing blows up goes to show that nothing was highly risky. You don't have like banks which very aggressive with certain dodgy products. Otherwise, the banks would have blown up already. Between last year and this year, nothing much has changed. I believe all the banks' books are still very, very clean. Usually, the risk of financial crisis is only very high after many years of bull market and strong economic growth. That is when all the banks, hedge fund managers, or some asset managers as well, start to become overconfident and start to buy very dodgy stuff, highly leveraged products. But we are definitely not there yet, nowhere near that. So I won't worry about financial crisis. So if there's a recession next year or the next 2 years, I believe it's going to be, compared to 2008, it's going to be very modest. It won't be that painful. And second, the time it takes to recover will also be shorter than 2008 because nothing blew up, not that much mess to clean up. Second part is what will trigger it. As I shared, usually, most of the time, recession is triggered by when the economy overheats. Actually, this part. When the economy is so strong, overheating, and employment is full, everybody spends, inflation gets higher and higher, then central banks have to raise interest rates. But the problem with inflation is that it tends to behave in a lagging impact, meaning you can raise interest rates, but the next 2 years, inflation will not come down that quickly. Inflation tends to be very stubborn for about 2 years. So it usually takes 2 years of rate hike before inflation starts to come down, starts to stabilize and gradually come down. But usually after 2 to 3 years of rate hikes, it's usually too high already, and economy starts to slow down. People start to hold back from buying new house and buying new car because interest rates is high. Businesses don't borrow that much money to spend because interest rates is high. That's when economy starts to slow down, and it's a bit like a self-fulfilling cycle. Businesses don't spend, they fire some people lose their job, then they spend even less, then demand for the economy go lower, businesses see their profit falling, then they fire even more people, then it triggers a recession. Besides that, what could trigger it next year? Honestly, nobody knows who could have predicted coronavirus. One obvious risk now is definitely China. Because you do all these things, if you are private businesses in China, you will really think twice before you invest more or spend more to expand your businesses, right? So when businesses don't spend as much, meaning if China keeps doing all this regulatory interruption for another 6 months or 9 months, I think it will start to hit domestic consumption. And when domestic consumption in China slow down, it tends to have a knock-on effect to the rest of Asia as well. Because China today is the second largest economy in the world.
Yeah, you're right. Yeah.
But knowing Chinese government, they tend to be very pragmatic. There's no reason for them to be too aggressive for too long until there's a recession, because they also don't want to look bad. They also don't want day-to-day people to blame them, right?
Yeah.
Especially next year is the party congress.
Yeah. I think they're just probably putting in some cooling measures, I guess, because the market has ran quite a bit. There has quite a bit of inflows since last year. So I think they're just probably putting in some cooling measures to cool the market down a bit. Okay, so thank you very much, Mr. Lim, for your explanations. So for those viewing this show today, Mr. Lim has given us a template, more or less a template of how it would look like. Let's say if a recession were to come, okay. Nobody knows when will the recession will come, but at least right now we have some key pointers that we can take away and some things to look at, moving forward in our investment journey. So thank you very much, Mr. Lim, for your sharing. We really appreciate it. For
Welcome.
For today. Yep.
Right.
Okay, so we have next show next Thursday with Michael Brock from Manulife. So stay tuned. Our promotion of 0.5% for the recommended unit trust is still on. So do head to www.fsm1.com.my and have a look at our recommended funds. There are quite a number of Affin Hwang funds over there. You can take a look at them, and if they are good to you, you can think of putting it in your portfolio. Okay. So thank you very much, Mr. Lim, once again, and also from the Affin Hwang team. We will see you again next. Okay, take care. Stay safe. Goodbye.